What's up, you guys? My name is Nico, and in this video I'm going to be talking about the basics on options trading. Now, there are some good YouTube videos out there that already talk about this, but they are very lengthy. So my goal for this video is going to be to give you that same information, just with a lot of that fluff taken out and maybe a little less detail on things that I don't think are extremely important to know. The first thing I want to mention is what exactly is an option. And an option is just a contract or an agreement between two parties. You have an option buyer and then you have the option writer, also known as the option seller. So what is the difference between options and just buying and selling regular shares of stock? And to answer that, there are three main differences between options and stocks. The first is that every option has an expiration date. Now, that expiration date might be tomorrow or it might be 2.5 years from today, but they all expire. You can buy shares of a regular stock and hold it for however long you want. There is no expiration. The second difference is that all options have something called a strike price. A strike price is going to be a predetermined price of the stock at which shares of that stock can be bought or sold at. And I know that just sounds like a bunch of words, but I'm going to explain what exactly that means in just a few minutes here. And the third difference is that all options have something called an options contract multiplier. Because every option controls 100 shares of stock, the pricing of options is a little bit trickier than the pricing of shares of regular stock. So let's say you wanted to buy Apple, and every share of Apple right now is around $135. So you pay that $135 and you receive that one share. But let's say you're looking at buying an option for Apple and you see a price of $4.60. The actual price that you're going to pay is going to be 100 times that, or $460, because the price that you see on your brokerage is going to be the price per share. But whenever you go to execute that order, you will see that the price is actually going to be 100 times whatever you see. So just keep that in mind whenever we look onto my laptop and we're looking at all the options prices. Now, before I start explaining in depth more about options and really get into the meat and potatoes, or is it the meat and bread? Anyway, before I really start explaining options, I want to briefly explain why options are so intriguing to many, and I want to also address kind of its risk, because it has a pretty bad reputation. So options are very intriguing to a lot of people because it allows you to leverage your money. So you can make option trades that are very risky, but you can actually make options trades that are much less risky. So it just depends what strategies you're doing and what options trades you are making. So just keep that in mind, and that's something that I'm going to address more in depth later on towards in the video, so you have an idea as to how risky certain trades might be. Okay, so as I said earlier, there are two sides of the trade that you can be on. You can be the option buyer, or you can be the option writer, also known as the option seller. So there are two sides to the trade, and then there are two types of options that you can trade. You have something called a call option, and then you have a put option. So you have buyers and sellers, and then you have calls and puts. So I first want to briefly talk about the buying of options. Whenever you buy an option, you are paying money. You are paying a premium. And for that premium, you are receiving a right. And it's important to understand that there's no obligation, that it is just a right. So whenever you are buying a call option specifically, you are buying the right to buy 100 shares of a stock at a predetermined price. Now, I'm going to give a brief analogy before I show it on my laptop and show examples of call options. But if you already understand what buying a call option is, just skip ahead of this. Actually, if you already know what buying a call option is, I don't even know why you're watching this video. Thanks for being here. But anyway, as a quick analogy, whenever you're buying a call option, let's say that I own a store and I sell these phone cases here. And this phone case costs $20. So you come in the store and you say, I want to buy that phone case, just not right now. So I tell you, okay, you can reserve this phone case, but it's going to cost you $2. So you pay me $2, I reserve this phone case with a price of $20, and I'm going to give you an expiration of, say, 1 month. So anytime between now and 1 month, if you come in the store, you can buy this phone case for $20, and it just costed you $2 to buy that right. So let's say you come in the store a few days later, and for some reason the price of phone cases, let's just say the demand went up, and the price of phone cases, or this phone case, is $30. Well, you own the right to buy it at $20. So you could buy it for a $10 bargain. Well, technically it would be an $8 bargain because you paid $2 for the contract, for the right to buy this. But that's still a really good bargain. You're essentially paying $22 for a phone case that costs $30. That is a little bit oversimplified, but that is what buying a call option entails. Now, in the other scenario, let's say you came into the store and the phone case was actually $15. Well, obviously you're not going to use your right, your contract, and buy it at $20 if you can just buy it at $15. So in that case, you just wouldn't use your contract and you would lose the $2 that you used to buy that contract. All right, so very quickly before I show my screen and look at call options, whenever you buy a call option, you profit if the stock price moves up. Okay, great. So right here, I have the Apple call options pulled up. I'm on Robinhood currently. I have an expiration set to March 12th. So we're looking at the March 12th contracts. And right now, the price of Apple is $134. I don't know why I'm deciding to make this video on open trading hours because everything is going to be moving, but we'll just make do. So let's say that we think Apple is going to go up and we want to buy this contract right here with a strike price of $134. If you look up here, this is the strike price. And then if you look all the way on the right, this is the price of the actual contract. So $4.60. Remember what I said earlier, the actual price of this when you go to execute this order is actually going to be $460 because this is the price per share. Because every contract controls 100 shares, the actual price of this contract is $460. Okay, awesome. So let's say that we buy this contract here for $460 with a strike price of $134. So let's say that a few days later, Apple goes up to $140 per share, a $6 increase. So you have the right to buy it at that lower strike price. So the price of your contract is also going to go up. There are three things you can do whenever you buy an option. The first is you can exercise that option, meaning you can buy the 100 shares at the strike price you chose. So if you wanted to, you could buy 100 shares of Apple at $134 a share, even though it's at $140 a share. Let's say it went up to $140 a share. But let's say that you don't have the money to do that, so you would need $13,400 in this case. Let's say you don't have that money or you simply don't want to own 100 shares of Apple. Well, that's fine. You don't have to exercise an option. The second thing you can do is you can sell to close that position. So as the price of Apple goes up, so will the price of this contract. So instead of exercising it, you can just sell that contract for a profit. It's important to note that you can sell a contract at any point you want. So whether the stock goes up or down, you can always sell that contract. So the second thing you can do is you can just sell that contract. And then the third thing you can do is just do nothing at all and let that contract expire. So let's say that the opposite happened. Let's say that right before expiration, Apple is down to $100 per share. Well, obviously you're not going to exercise that option. So what happens? Nothing. You don't do anything and you simply lose the amount of money you paid for that option. So whatever premium you paid. So in this case, the $460 you paid, you would simply lose those $460. Okay, so that is what buying a call option entails. Now, let's say we wanted to buy a put option. Whenever you buy a put option, you're still buying an option, so you're still buying a right. You're paying premium for a certain right. But now, the right, whenever you buy a put option, is you are buying the right to sell 100 shares at a predetermined price called the strike price. So in the case where we wanted to buy, let's say we thought Apple was going to go down. So instead of buying a call option, let's say we bought a put option. So we toggled the put option and we buy this put option here that costs $413. So let's say that a few days later, the price of Apple drops down to $100 per share. Well, because you bought a put option, which gives you the right to sell 100 shares at the strike price, if the price of Apple goes down to $100, but you have the right to sell it at $134, well, you would be selling it at a higher price than what it costs. So if you're selling it for a higher price, you would be making more money. You would be profiting. So whenever you buy a put option, you profit whenever the stock goes down because you have the right to sell 100 shares. You want to sell something at a higher price than its current price. Everything else applies to the put option, meaning you can exercise the put option, you can sell the contract. So let's say the price of Apple goes down, you can just sell that contract, or you can just not do anything. So let's say you bought a put option for Apple, but Apple just kept going up. You could just let that contract expire and you would simply lose the amount of money that you paid for that contract. So now that you kind of understand what buying a call option and buying a put option entails, I want to dig a little bit deeper in some important criteria that you need to understand whenever buying options. So I'm going to open up this, right now we're looking at buying a call option, and I'm going to open up this contract right here, this $134 strike price for what is now $455. So a few things in here that I want to go over. Let's briefly go over, just in case you don't know what volume is. The volume is going to be how many times something has been traded that day. Open interest means how many of these contracts are currently open. And then you have implied volatility, which is a very important concept to understand. So I'm going to take a little bit of time on this because I think it's very important. So implied volatility, at a very basic sense, a little oversimplified sense, is really just the demand for an option. So if an option has a very, very high demand, meaning a lot of people are buying and selling those options, the implied volatility is going to be high. Whenever you have a high implied volatility or high demand, the price of that contract is going to go up. Because something called mean to reversion, meaning that implied volatility with time tends to go to its average. So there's average implied volatilities for every stock. So if you have an implied volatility with an average of, let's say, 40, and whenever you're looking at buying an option, let's say that option has, well, right now, I don't know what the average for Apple is, but it says 29%. Let's say, I don't know what it is, but let's say that the average implied volatility for Apple is actually 40%. Well, right now, 30%, that's below its average. That means that with time, you have a pretty good probability that the implied volatility will go up to that average of 40%. Now, as the implied volatility goes up, so will the price of your contract, which you want. Whenever you buy an option, you want the price of your contract to become more valuable so you can sell it at a higher price. So implied volatility tells you how much demand there is for an option, but implied volatility by itself isn't very helpful. We have to see how the implied volatility is for that stock throughout the year, because you can have two completely different companies with very different implied volatilities, but it's important that you compare it not to the other stock, but to its historical average. So if you're looking at the implied volatility of this company, you have to look at the average implied volatility for that stock and not compare it to anything else. The way that we can see the average implied volatility for a stock is we can go to Google, type in the ticker symbol, and then type in implied volatility. The first thing that pops up, this is what we care about, marketchameleon.com. So I click on Market Chameleon, and then, well, right now it's not letting me see the graph. It's telling me I have to pay. Sometimes it lets me see the graph without paying. Sometimes it doesn't. I don't know, but that's okay. We don't need to see the graph. It is nice, but we don't need it. This is what we care about. So if we read right here, we see Apple's implied volatility right now is 29.1, which we saw here is 29.6, so very close. And then it says, which is in the 11 percentile rank. That is the important number, 11 percentile rank. It says, this means that 11% of the time, the IV was lower in the last year than the current level. So that means that if that number is below 50%, the 50 percentile rank, that means that the IV is currently below its average. So right now, if you were very bullish on Apple, it might not be a horrible idea to buy a call option if you were obviously very bullish on Apple, because many times people who are buying options rather buy options with a lower IV rank. So this percent is what really matters. This is what allows us to compare it to its average. Awesome. So now I want to briefly go over this right here, the Greeks, which is important to understand as well whenever you're buying an option. So let's first go over delta. So delta is going to tell you how much the price of your contract will change for every $1 change in the underlying stock. So for example, right now, Apple is $134.40. Let's just say it's $134 right now. That means that if Apple goes up $1 to $135 per share, the price of your contract here, this price will go up by a factor of delta. So your contract will go up by 53 cents. Remember that the prices of contracts are being shown per share basis. So the actual dollar value would be $53. So this $460 contract would go up by $53 if Apple went up by $1. Now let's move on to gamma. Gamma is going to tell us how much delta is going to change for every $1 move in the underlying stock. So if Apple goes up from $134 a share up to $135 a share, delta is going to go up by a factor of gamma. So delta will go from 0.53 to about 0.56 or 0.57. So you can see that with every additional increase, because delta is not a flat number and it will move according to gamma, every additional increase is going to be a bigger and bigger jump in your contract's price. This also goes both ways for delta and for gamma. So whenever the price of Apple, if it were to go down, the price of your contract would go down by $53. So it's important to note that this goes both up and down. This Greek that I'm about to talk about is theta, and it's a very, very important one to understand. Theta is going to be also known as time decay. So whenever you buy an option, every day that you're holding on to that options contract, you are losing money to theta. Silently, you don't really see it. It just kind of, the value of your contract starts losing money. So you can see that theta here shows a negative 0.07. That means that if by tomorrow the price of Apple does not change at all, the price stays completely perfectly flat, and also assuming that the implied volatility doesn't change at all either, the value of your contract, this $4.60, will drop by 7 cents. So you'll go from $4.60 to about $4.52 or 53 cents. So in dollar value, this would be a $7 drop in your contract if everything stays the same. It's important to note that theta is also not a flat number. So the closer you get till expiration, the higher that theta is going to become and the more money it's going to take out of your contract. So it's important to be aware that this is something whenever you're buying options, the longer something takes to happen, the worse it is for the option buyer, because you need things to happen in your favor in a quick period of time, because if not, you're just bleeding money out to theta. So I pulled up a simple graph here that kind of shows the way theta works. So you have your option value here on the y-axis, and then you have the time remaining until expiration. So if the price of the stock remains perfectly stagnant, you can see that with 120 days out, down up to 30 days out, the price of your options value is decreasing. Not at a crazy fast rate, but it is decreasing. But you can see once you hit about 30 days, that slope really just plummets down. So that theta really starts to ramp up. So this is just something to be aware whenever you are buying options. Okay, so I realized later on when I was putting the video together that I completely forgot to talk about Vega. So I'm gonna do that right now. So the last important Greek is Vega. And Vega is gonna tell you how much the price of your contract changes for every 1% change in implied volatility. So right here we have an implied volatility of 28.4. So that means that if the implied volatility were to increase by 1% up to 29.4%, then the value of your contract would go up by 14, or I guess it would be 15 cents. So you would go from $4.95 to $5.10. So the dollar value, again, would be 100 times what you're seeing here, so it would be about a $15 increase. All right, this is the last correction. I forgot to mention that Vega also applies whenever implied volatility goes down. So if implied volatility drops by 1%, then the value of your contract will drop by whatever factor of Vega you have for that contract. So that concludes the option buying side of options trading. You do have a whole nother side, which is the option writer, also known as the option seller side, because there's someone on the other side of these trades. Whenever you're buying, say, a call option, you have somebody who's quite literally creating this option by writing it out and selling it to you. That side of the trade I was going to include in this video, but I wasn't sure if the way I'm teaching it now is very easy to understand. So if this was helpful, please let me know in the comments and I will immediately make a video on the other side of option trading.